Well, good morning, everyone. On behalf of Morningstar, I'd like to welcome and thank you for attending today's first behavioural coaching webinar for advisors with our global thought leaders in the field. For those that I haven't met, my name is James Lowe, and I'm a proud member of the Morningstar team that partners with advisors and practices and licensees to provide our solutions and services in a manner that not only aligns with best practices that we see from advisors across the globe, but most importantly, what makes sense for your firm and advice process. The Morningstar team are delighted that you can be here. We know and understand what a commitment it is for you to be away from your business and clients in these challenging and volatile times. We're humbled and privileged, and we're going to do our very best to make this as meaningful as possible for you. Just in terms of the first disclaimer, this advice in this webinar is general in nature, which means we haven't considered anyone's personal circumstances or financial objectives. Just in terms of some housekeeping, there will be a Q&A and a chat at the bottom of the screen. Please do send your questions through. We're really looking forward to getting them, and we had some fantastic questions before we came on air. There will be an exit survey at the end. Please do, when you exit, complete that. Again, we value your feedback, how we can better serve you, and there most certainly will be a follow-up with you that will be able to assist you in your client interactions going forward. So just in terms of the session today, we thought it was valuable, as this is Morningstar's first significant webinar in Australia that is purely focused on behavioural coaching best practices for advisors. We really thought it was important to provide a background to our focus in this area and frame up the structure of what you're going to be hearing today and more of into the future. In particular, as this is an incredibly important field of study and not necessarily well understood consistently across Australia. So in addition to investment portfolio risk, an equally important source of risk is behavioural. This risk results from people, you, your clients, or humans, acting as their own worst enemy and potentially making unhealthy financial decisions that can potentially reduce their long-term wealth. High-quality financial advice requires taking into account what is financially necessary and what is psychologically possible for your clients. This means, as advisors, simultaneously dealing effectively with both investment and behavioural risk in a coherent and integrated way. However, behavioural risk cannot be solved with the well-known approaches that are used to diminish investment risk. Behavioural risk requires different kinds of solutions. Well, what are these solutions? Looking back before behavioural finance existed, smart, thoughtful investors and observers of the world, such as Benjamin Graham, the father of value investing, realized that investors often struggled, not because of the maths, but because they were human beings. They realized that investors often act as their own greatest enemy, and it was the psychology of investing that often causes people to falter. Investing really is simple, just not easy to follow through because of psychology, in the words of Warren Buffett. In the late 70s and 80s, we saw the identification and cataloging in the behavioral field of hundreds of different behavioral biases. And from this compendium of errors, human frailties, we learned that if advisors and your clients are smart, careful, and understand these biases, they can often be avoided. However, over the last decade or so, we've learned in study after study that while education about behavioral biases is absolutely essential for advisors, it's nowhere near sufficient to make a meaningful difference to your clients. For example, if an advisor, knowing that your clients have an overconfidence bias and being able to see this behavior in your clients, it's simply not enough. Consequently, the behavioral field has moved to advisors not only understanding that your clients may not actually do what they say they want to do, but how do we actually practically help them? And that is where the cutting edge is right now and where our focus lies at Morningstar. Practical, field-tested behavioral techniques to determine what actually helps the clients you serve overcome these biases, helping you as advisors change the way your clients structure investment decisions is where we at Morningstar see the great future of behavioral finance in better empowering investor success. And that's the purpose of today. Morningstar is a dedicated global behavioral science team under the leadership of Dr. Steve Wendell, who you're going to be hearing from shortly, studying and producing thought leadership in how our fundamental wiring as human beings drives our behavior and how that can undermine the potential of your clients to build wealth in markets over time. With that in mind, I'd like to introduce you to our 3 senior global thought leaders in behavioral science. We will discuss exactly how you as advisors can cultivate this calm, thoughtful, goal-directed behavior that prevents your clients from acting as their own worst enemies, to rather make those healthier, better financial decisions that we all want them to take. Steve, Ryan, and Sarah are all doctorates in the field, and I know I'm incredibly excited to be sharing the insights with you to better empower the success of your clients. Good evening, Stephen, Ryan, and Sarah. Thank you for being with us. I know it's extremely late to your time, even though it's 11 o'clock in the morning hours. I'll hand over to Steve, who will do a brief introduction before handing over to Ryan. Thanks, Steve.
Oh, Steve, you are on mute.
Yep. Thank you, James. As James mentioned, I'm Steve Wendell. I run the behavioral science team at Morningstar. I'm joined here by Dr. Sarah Newcomb and Dr. Ryan Murphy. And what we want to talk to you today is about the challenges that investors face and that advisors face in working with them in the current COVID crisis. Now, many people are very rightfully concerned about what the pandemic means for their own health, for their families, for their livelihoods. And we see this concern reflected naturally in the markets. We are human beings. We can't compartmentalize fully. We see it both, of course, in what we think will happen to the value of companies, and we see it in our own fear. And so we see, of course, a tremendous drop in March, upswing back in April, and who knows what's coming next. And so today what we wanted to do is we wanted to give you some tools to understand what's going on, and especially what to do about it. Ryan will cover the foundation of knowledge about behavioral biases, what they mean, what behavioral science is, and how this affects everyday behavior. Second, Sarah will talk about the emotions of the moment with the understanding that really this time is a bit different. That in fact, while we have a core understanding of the mind and our biases affect us at all times, well, fear matters and the pandemic matters, and we want to understand how advisors can best help. And that leads us into the third section, which I'll be talking about, which are practical techniques that individuals can use, right? Individual advisors, individual financial planners, to work with their clients to help overcome these. Now, all of what we'll be talking about today is available in a set of guides that you will see, that we'll be sending to you via email tomorrow. So these guides, one on the left is kind of a detailed guide that goes into a body of theory, what these biases are, how they work, and then the tools. And the right-hand one is just the quick, straight to the point, here's what you can do. In this situation, here's a technique. In this situation, here's another technique. And with that, I'd like to turn it over to Ryan to get started on the fundamental understanding of our biases in behavioral science.
Great. Thank you for that, Steve. Thank you all for joining us. I'm very pleased to be able to speak to you today. So what I want to talk to you about now is what we're trying to accomplish in the behavioral and decision sciences. This is an empirical, data-driven undertaking where we try and bring together insights and methodologies from psychology and economics and other closely related fields. It addresses 3 core research ideas. So the first of these is we imagine what would a perfectly rational decision maker choose. And this is useful. This is useful as a benchmark and as a starting point. And it's also the foundation of a lot of economics and finance. If you open a textbook, it says markets are populated by these perfectly rational beings. Now, I'm sure in your practice, you might have noticed that people don't always make perfectly rational choices. And that leads to our second line of research, where we start to look at what real people do. And this has been informed widely by experiments coming out of psychology and experimental economics in the last decades. And what started to emerge is a picture of people who are flawed, but those flaws are not necessarily random. There's a structure to the kinds of mistakes people make, which leads to the third kind of research we think about is given what we know about these predictable irrationalities, how can we use these to help people make better decisions? So what I want to talk about a little bit are some of the choice biases, and I'm sure you've heard about these things. Now, biases are persistent, systematic deviations from rationality, not just mistakes, but the kinds of mistakes that most people make most of the time in a particular situation. How many biases are there? Well, hundreds. If you go look at the Wikipedia page, the count now is well over 200, approaching 300, and new ones get added every month. But really, there's some big ones, and there's some big ones that are particularly important when we think about decision-making in finance. And today I want to talk about 2 of those overarching ideas. First one is overconfidence, and the second is loss aversion. And I'll deal with each of these in turn. So overconfidence, this is when our subjective confidence in our judgments is greater than the objective accuracy of those judgments. And so if you've ever had the experience of saying, I know I'll be able to finish this by the end of the week, and then come Friday afternoon, you're kicking yourself saying, I can't believe I actually thought I was going to get this done, that's overconfidence. This happens to all of us, and it happens often. In investing, it can be particularly pernicious because if people are overconfident while investing, they can misperceive and underestimate downside risk, and that can lead to profoundly bad consequences. We also know that investors fail to adequately diversify if they're overconfident. And investors' overconfidence can fuel overtrading, which we know undermines performance. So as an advisor, what to look for is when a client says, I'm certain this will happen. That's a sign that this person might be overconfident. Investing requires that we deal with persistent uncertainty, and helping people appreciate that is a useful thing. One of the other things that drives the overconfidence bias is something called the confirmation bias. And this is the tendency people have to search for and interpret and recall information that confirms their existing beliefs. So people start with a conjecture, and then they only look for supporting evidence. So one counteraction for this is to remind people that when trading, every trade has at least two sides, right? There's a buyer and a seller, and it's worth thinking about the other side being at least as smart as you are and at least as motivated as you are to make money. So why would they be willing to take the opposite position? And that sort of effort to try and explain the world from a different vantage point can help people avoid the confirmation bias. From a client standpoint, you can imagine a client coming in and saying, I've Googled all the reasons this is a really good idea. I think that's a great opportunity for an advisor to step in and say, well, let's start to talk about the things you didn't look for or other information you may not know about that might help flesh out this decision a little bit more so. We also know that our memory sometimes contributes to our overconfidence. And so, for example, there's this thing called the recency bias. And this is the tendency people have to more easily remember things and call to mind examples that happened recently. So during a bull market, it's very easy to remember the upside of markets. And one counter to this is that advisors can use is to provide their clients with a long-term and historical perspective when discussing investments and help remind investors about the really overarching long time scales that they should be thinking in. It's really easy to get lost in what the market did last week and what the news is talking about, but really people's overarching long-term goals are 25 years or so in the future, and it's worth reminding people of this. So what to look for? So people who are exclusively focused on what happened in the market very recently. And I think that's a chance for advisors to really show their value by helping recast what investing is about, and that is a long-term process. I'm sure you all know about the herding bias. This certainly contributes to overconfidence. This is a tendency people have to put too much weight on what others are already doing and then try and follow. Obviously, looking at what others do can be a useful source of information. So for example, trying to pick out a restaurant, following the crowd can be useful. But when it comes to investing, this could start to backfire. We know that there's positive feedback in how prices move, and little moves can beget large moves, and this can drive prices far away from their fundamental value. As a counter, it's worth reminding your clients that there's a big difference between speculation and investing, and that a strategy that persistently tries to outguess the madness of crowds is really not a good long-term strategy. Signs of this, what to look for, about clients who are saying, well, everyone else is doing this, or they have some sort of fear of missing out. And it's worth reminding them that sometimes there's a lot of value in what people have overlooked, and especially our view being a bit contrarian, using that as a vantage point where the rest of the herd is headed, we might want to start to look the other direction. So those are some of the things that contribute to overconfidence. Let me turn now to loss aversion, one of the other large ideas, one of the large biases we know of. So one of the cleanest ways to show what loss aversion is an example that comes from experimental economics. So imagine that I offer you these two options. You choose option A, nothing happens. You choose option B, and I flip a perfectly fair coin. There's a 50-50 chance. If it comes out heads, you earn a certain amount of money. I give this to you. If it comes out tails, you lose $100. Let me put in a value of X here to see who would be interested in this particular option B. So imagine that the gain amount here is $95 and the loss is 100. Again, perfectly fair coin. How many people would be interested in taking option B? So when I give these talks in front of large groups of people, option B here is staggeringly unpopular. Nobody wants this. So you put someone on the spot in the front row and ask why. And they say, well, look, the gain just isn't big enough to justify this. The expected value is negative. I'm not interested. Say, okay, let me change it just a little bit. So what if the gain amount now is 105 and the loss amount stays the same? Are you interested? By the line of reasoning you've given, all the hands in the room should shoot up, but they don't. Vast majority of people find option B unappealing still. So you have to keep increasing the gain amount here until you start to get people's attention. And it turns out when we do experiments like this, the gain amount has to increase to about 200 to 220 before people are really interested in taking the risky option. They're leaving a lot of money on the table. Many of these other options for less gain than 220, that's a really attractive gamble, but they still want to avoid it. The psychological reason here is loss aversion, and simply put, losses loom larger than gains. Losses are more painful, then gains are pleasurable, holding the magnitudes constant. So this is deep and something that's pretty hardwired in how people think and feel, and it can manifest itself in markets. So imagine that you have an investor, and this person is invested simply in the S&P 500 index. If she checks her portfolio performance every day, she will see decreases about 46% of the time by slicing up performance into daily sorts of slices. Now, if she were to only check every week, she would see fewer losses, down to about 43%. And if quarterly, losses would only be there about a third of the time. Now, we're not changing the asset allocation. It's exactly the same investment. What we're changing here is how the time scope is of the person viewing this. So we know that people are hypersensitive to losses, and a person who's looking often is going to experience every little up and down, and that's a lot of downs to experience. But by chunking the results, by looking less frequently, people will see fewer downs. And given that we know people are hypersensitive, this is a way to tamp down the potential effects of loss aversion in inducing them to make bad decisions. So by looking more often, an investor can make herself less happy. And this is a great example of where ignorance can be bliss, and especially when it comes to enduring market volatility. Research shows that people who examine their portfolio's performance less often do better. They feel better and they do better in the long run, as they feel less tempted to fiddle with their asset allocations and make unwise trades for emotional reasons. So this point was really driven home to us. Kahneman came and visited us a couple of years ago, and here he is talking with Sarah on the main stage of the Morningstar conference. And he was talking about loss aversion, how this can affect investors. And he had this great quote, which I really liked. Let me share it with you. When investors see something bad happen, they may want to change direction, change advisors, change and go do something else. This is the biggest danger for financial health. So these were the two overarching ideas I wanted to cover, just talking about some of the biases that people face, overconfidence and loss aversion. And even in the best of times, it's not easy for people to make rational long-term choices about risk, money, and investing. And volatility makes that all the more difficult, and the kind of global uncertainty we're all facing now makes it even more so. Behavioral science can give us some insights into the kinds of common mistakes that people make, and this, I think, can help arm advisors with ways to help coach their clients to avoid the common pitfalls that people may fall prey to. So next, I want to turn to Sarah Newcomb, who's going to be talking with us about the emotions in the moment and the psychology behind that.
Thank you, Ryan. We've had some questions come in, and I think we can go through. I think we've got a bit of time to go through a couple of them before we hand over to Sarah. One of the ones that has come through. Can you share some tips on how to address clients' concerns about investing without making them feel silly or inadequate? As we often know, and Ryan, you might be well positioned also to answer this one. I know you did some research last year that was awarded the FPA in the US Independent Researcher of the Year in terms of the value of an advisor. And I know one of the aspects that came up there was the what the reference to behavioral coaching and the language around it. It might be worthwhile. You might be best positioned to answer that one.
Sure, let me just briefly go into that. So I think this idea that biases are not just something that other people suffer from, I think it's worth highlighting this is something that we all struggle with. And the research that's coming out shows us that there's some sort of order to the kinds of mistakes people make, which gives us a little bit of a map to better understand ourselves. And I think that advisors who can help their clients understand that this is just part of the human condition and an inherent part of investing can establish that connection. So it comes off then, I think, as less judgmental. And this is something we all are struggling with. So if advisors can even give personal experiences of here's how I faced this particular bias, and here was a technique I used to actually make better decisions. So for the example of checking portfolios often, take the app off of your watch. I mean, that's, I think, a good step in having people think less about what their portfolios are doing and focusing their attention in places where they can have good impact. So, thanks for that question.
I think in the interest of time, we'll hand over to Sarah. Please keep coming, please keep sending in your questions, and we'll most certainly be going through them throughout the session. So we've just spoken through all the many areas of decision biases. Sarah will now talk to us about psychology of the moment. So over to you, Sarah.
All right, great, thank you. So yeah, let's talk about what emotions are doing to us as investors and to your clients at this moment. We've seen a lot of emotions. One of the most important things to understand is that even in the best of times, investors are prone to mistakes because of the biases that Ryan just talked about. And I think that Ryan made a good point in bringing up to clients that these are typical. We talk about mistakes and irrational, and those words have an inherent sort of judgmental language to them that's not really intended here. Mistakes and biases are simply just human things. They're not even necessarily errors. What's happening is that our emotions are adding information to our decision-making processes, and we need to understand how to weigh the emotional information, because sometimes we weigh emotional information too heavily. So I'm going to talk a little bit about the specific emotions that a lot of people are facing with right now, what to listen for, and how you can handle those emotions as they come up. So we know, again, that even in normal times, we're prone to biases and misjudgments because of emotions. But when crises strike, we're even more at risk for making mistakes, because the unnatural emotional responses that we have amplify problematic decision-making, problematic thinking. So in these times, we need our minds to be flexible and open to new information so that we can problem solve and think clearly. But unfortunately, time pressure, negative emotions, exhaustion, and other stressors, all things that I think we all have had more than our fair share of in the last few weeks, these all amplify cognitive rigidity, for one thing. So cognitive rigidity is a closed and inflexible state of mind. And that is not ideal for good financial decision making. So while you can't remove emotions from the picture, you can help you mitigate the impact of those emotions on your client's decisions. So let's talk about a few of the different faces of these emotions. One in particular, fear. So people have very strong and very different responses to fear. Here I'm going to describe three main reactions, what to listen for, and how to coach your clients through each of these reactions. So first is the most obvious, the one we talk about the most in times of panic, and that's risk aversion. Most of us are risk and loss averse by nature, but not everyone, and I'll get to that in a minute. Some people respond to fear by becoming more risk averse. This is rooted in a strong desire to reduce uncertainty at all costs, which is something that we simply can't do right now, but our natural desire is to reduce uncertainty at all costs. So even if that means locking in major losses to avoid the chance of more bad news in the future, for some people, the emotional benefit of having their money feel safe in the present moment can feel more important than the idea of recouping losses from the past month. So the stress hormone cortisol that's involved with fear has been shown to increase risk aversion in experimental studies. So people who were calm when volatility was low can still become risk averse under the influence of stress. So to spot heightened risk aversion, this one is the one, again, we talk about the most. You'd be listening for catastrophizing, for what if scenarios, listening for all the possible worst case scenarios that your clients are thinking about. And when you hear this in clients, when you hear their fear coming through the desire to move to safety or reduce threat, one thing that can be really helpful is to ask them about regret. Actually dig into those worst case what if stories that they're telling themselves, because the reality is that the probability of the ultimate worst case happening is much more unlikely than we give it credit for. Reality will probably be somewhere between the worst case scenario and the best case scenario, but we can torture ourselves with worst case scenarios all day long. So helping your clients to imagine those worst case scenarios and then deciding which of the worst case scenarios are the least worst. This is a technique that Gerd Gigerenzer and colleagues came up with that is just about thinking through the negative what ifs and deciding what choice would lead, rather than thinking what is the ultimate best choice, sometimes thinking what is the choice that will lead to the least regret can be a useful way of reframing things when you're in the grips of risk aversion. So cortisol is a very powerful motivator, but so is adrenaline. And this can motivate some investors. Rather than becoming risk averse, some investors become risk seeking. And some people will think, well, if I've already lost money, why not double down? And they use uncertainty and the unpredictability of things as an excuse to speculate and to gamble beyond their means. Other people may be thinking that if there's no chance of recovery, they might as well try and add on more risk. Other people are looking at the opportunities that are represented by this market and are in the grip of overconfidence because suddenly they've heard about some hot tip stock and now they want all in. So what you want to do is listen for hunger, listen for urgency in clients' tones. Do you have an otherwise offhand client that's suddenly really interested in scooping up shares of some hot biotech firm that they read about on Google yesterday? So this is the kind of risk-seeking overconfidence that adrenaline can have on us. So instead of just dismissing hot tip stock ideas and people wanting to charge into the fray, you might want to say, great, you want to add some biotech to your portfolio? Wonderful. Let's talk about how we can fit that into your long-term strategy. Maybe we can add some exposure in that area. And that way you can help them to take advantage of the opportunities that risk seeking can provide to them without letting them become prey to a full-on bout of adrenaline-fueled stock purchasing. Thirdly, we have decision paralysis. And so this is otherwise known as the freeze response or avoidance. And in this case, investors feel paralyzed. They don't know what to do, so they do nothing. And in some cases like this may actually be a benefit because if they're avoiding their reality, then they may not move their money. But if they're avoiding good opportunities and sitting on overpriced investments, but they just don't have the confidence to choose, then it can become a problem. So to spot avoidance, you want to listen for conspicuous silence from otherwise in-touch clients. Maybe they're feeling a bit overwhelmed, or a general sense of resistance to even justified investment opportunities. And when you're trying to help clients who freeze, it might help to walk them through the possible outcomes of action versus inaction to help them see the cost of not taking advantage of opportunities when they truly are there. Next, we have stress, and what stress can lead to is rumination. And this is problem solving, but on overdrive. Rumination is when we get stuck in repetitive negative patterns of thought that not only fail to solve the problem, but the act of ruminating itself exhausts us and stresses us more. So rumination amplifies present bias, myopic loss aversion, and it leaves people prone to making really short-sighted decisions that hurt more than they help in the long run. To spot rumination, you want to listen for indications that a person feels powerless, listen to going in circles with reasoning, or feeling generally unable to stand up to the situation. Those are all signs of rumination. And interestingly, when someone is stuck in rumination, you may be able to help them just by asking them about their emotional support network. There is some interesting experimental evidence that supports the idea that when we are stuck in a ruminating cycle of thinking, just putting our attention on the people who have emotionally, not financially, but emotionally supported us in the past may be enough of a little bit of a mental trick to get us out of the fixed cycle of ruminating thinking patterns and get us to think long-term once again, because it allows us to relax for a moment and remember people have been there for us in the past and they will be in the future. There is a future. We can still think about it, and it can help break that myopic, very present bias focus that rumination brings. I want to say something about grief, but there's grief that your clients are facing in the grief of losing assets and losing perhaps some plans that they had their heart set on, maybe losing loved ones. But there's also the response to grief that you as an advisor need to watch for. And that's your own response. You are a caregiver right now. You're counseling people through very uncertain and scary times, and you're handling a lot of burden. And in doing that, caregivers often experience what's called compassion fatigue. And so you really want to watch your own energy levels and your own stress levels as you care for those that you serve. And don't skimp on your own self-care right now. It's like the oxygen mask on the plane. You need to be able to make sure that you are in good mental and professional condition so that you can be there for your clients. So if you are starting to experience burnout or compassion fatigue, please pay attention to that and look up resources on compassion fatigue for caregivers. It's a real thing. There are groups and resources that can help you to recharge so that you can be there for the people as that you're serving as they wade through their own fear and grief. And lastly, I want to give a warning against urgency for its own sake. Again, we're in a moment where uncertainty is high, and what people want more than anything is to reduce uncertainty. And to do that, we feel like if we can do something, just do something now. And the urgency of decisions can sometimes make us over prioritize things that feel time sensitive and under prioritize things that are less time sensitive but more important. And sometimes things are urgent but not important and still shouldn't be prioritized over those things that are purely and objectively important, not just time sensitive. So with that, I want to hand things back to Steve to help put a little bit more practical spin on what we can do, what you can do to help when you see these emotions taking hold of your client's decision making.
Thanks, Sarah. We've had a couple of questions come in, and might be a good opportunity to raise them now. One of the ones that's come in is, what ways are there to keep my clients focused on their long-term goals and not get caught up in the emotions of the moment? And I know, Sarah, I think last year you did a blog and some insights on the market is no benchmark, and to really focus on the long-term goals. Any techniques that you can sort of pass on to the advisors?
Yeah, I think that first of all, reminding people that I loved what John Renkenthaler, one of our commentators, said. The market is not the economy, and the market is not your portfolio. Your goals and your investment were chosen through certain strategies with a long view in mind. And to keep your eye on the long view means keeping your eye on the goal. So rather than having people thinking about their goal as a certain number in the bank that they're aiming for, the goal is the life that they want to lead, and helping them remember the details of the life they're working toward, thinking about the home that they want to buy in 10 years, remembering that 20 years from now still exists and they will still be plotting their course toward the future. So helping people to really think more in detail about the specifics of the long term. Right now it's difficult because people can't see past next week, and so they think, how could I possibly plan for 10 years from now? But I think the trick right now is to skip over the immediate few months or years that we can't see clearly, and remember that in the long term, there are still long-term trends. And while the short term is never predictable, the long term still has some elements of predictability. So the more that you can think 10 years out and further, and just get their attention back on those long-term goals, the better.
That's great. Actually, one question that's come in, and probably I know Ryan's done some thought leadership on goals-based risk, and Ryan, a question's coming on that old chestnut of risk profiles and risk profiling questionnaires and systems. I know you've got some views and you've done some thought leadership in that space, and perhaps linking on to the previous question of Sarah about the focus of long-term goals.
Right. I mean, this would be a seminar all to itself. I mean, very briefly, they can be a useful tool as starting a discussion, but really they shouldn't replace an advisor really understanding why a person is investing in the first place. So I'd be happy to have a whole other seminar around that. So.
Yeah, and I know it's something we're planning from a Morningstar perspective to do later in the year. So I think that's definitely something. The person who sent that question through, please watch this space. We will have time for more questions later. With that, I'll hand over to Steve.
Great. Thank you, James. Thank you, Sarah. So Sarah and Ryan have both mentioned a number of tools that you can use. My job is to bring those together and point you to the resources that we have available for you to research this in more detail. So the underlying approach to what both Ryan and Sarah were talking about is that we fundamentally want to attack the psychology of anxiety during down markets and greed during up markets directly. And we can think about the path between someone's investments going up and down and then making a hasty choice as a series of steps. Something happens to the investments, they receive information about that. They form an emotion because of that information, because of the story in their minds of what that means. Then they want to take an action, they make a decision to, and then they take action. And the good news is that behavioral science has a set of tools that you can use at each stage of that process, depending on where your client is in the moment. And so this is, for example, an excerpt from the checklist that will be mailed out to you tomorrow for free that we've developed, which is a set of tools, in this case, that you can use to prepare people when they're panicking, and also how you can help them when they're actually in that moment. And I'll talk about those in a little bit more detail. So let me just give a few examples of these techniques, and again, turn you back to the two guides that you'll receive tomorrow. One is, as Ryan mentioned, risk tolerance is often a starting point. One of the great weaknesses of the risk tolerance questionnaires are that, well, it changes with the markets. And one of the best predictors of one's risk tolerance is what the market has just done. And so this isn't to say that your clients come to you and say, you know, before I was aggressive, now I really need to pull back. They're not being insincere. They're just being human. And so it's a problem with how we measure. It's a problem with this approach. And we can adapt and adjust and understand that this is just a normal human reaction. And so we look to that information. Now, Ryan mentioned quite a bit about loss aversion and how people react to the downturns. And the more often they look, the more that they'll see down times. And we call that in particular myopic loss aversion. And the initial research was actually on advisors and traders on the field, that the more they looked at how the stock market was doing, the more conservative they became, the more it worked their behavior. And the solution to this is to set a regular schedule with your clients. Now, in normal times, that might be a quarterly review. We know that in times like this, that may not be feasible. Fine. So weekly, for example, how can we check in and talk about where portfolio is and how one is progressing towards their goals, and not check the news every minute, not check the news on your phone, etc., and get sucked in by that stress and that undue urgency that Sarah was talking about as well. We see as someone starts to react to that information. So you haven't set a schedule. They're seeing it. They're seeing that their market, that their portfolio is in trouble. How they interpret that and what that means to them and the emotion they feel isn't given. This is perhaps sometimes hard to realize, that there's a narrative in the mind, and that default narrative is recency bias. So I'm just talking about that if the market has just dropped 10%, then it's going to drop another 10%, and I need to get out right now. But you can arm them with a different narrative. Now, I myself am a contrarian investor, and so the narrative I have is, wow, we're in a much better price to fair value right now. And so that leads into another technique called anxiety reappraisal, which is it's very, very difficult to simply stop the emotions that Sarah mentioned, stress, anxiety, etc. But we can relabel them with that narrative, with an understanding, for example, contrarian understanding of investing and saying, look, this is the time I should be excited. I can take this feeling in my body and use it rather than simply try to deny it, because we're human beings. And it's very difficult to avoid that emotions, the emotions that we feel. You know, in the guide, you'll find many other techniques, in both guides, you'll find many other techniques on pre-commitment, on how you can help a person lock into the thoughtful course of action that they develop with you. Talk about techniques on how to reverse the confirmation bias by having people explain the other side of the trade in a thoughtful way. And we also talk about how you can use it, is how you can use the emotions of the moment to help somebody, to counter the vividness that they're seeing outside and provide a counterbalance. So again, this is a bit of a preview for what you'll receive tomorrow. There's so many different awesome techniques that you can use to help clients in these troubling times. But we know that we've had a lot of questions. We have many more. I want to just leave some time for those questions. So I'm going to direct you to the additional materials to really dive in and learn more about the techniques that Ryan and Sarah have been discussing. Let me just take a step back and think about where we've been. So we see in the markets, of course, a significant fall, and perhaps even more unsettling up and down since then. Nobody knows where things are going to go next. And it is in moments like these that our fundamental biases come out: overconfidence, our loss aversion, and with that, the confirmation bias, the other challenges that arise in investor behavior. This time is different in many ways because of the pandemic. I saw there was a question about that earlier. The health scare matters. This particular anxiety of our own livelihoods matter, and it amplifies this. It creates a cognitive rigidity. And we have tools to look out for this, to look out for the rumination, the constant cycling that Sarah mentioned, to help identify where a client is in the moment, and to then use the appropriate tool for their circumstance. Now, whether that is explaining the opposite, whether it's explaining the other side of the trade, whether that's adding friction, whether that is addressing the myopic loss aversion. Thankfully, there are many powerful techniques that you can use that are available in these two guides, both of which we make free for you. Again, the left-hand one, that's our researcher guide. That's for those who really like to dig in and really learn about this. It goes into the theory, not all of it, but we wish we could, but it has the citations, it has detailed information if you really want to learn more about this, including other resources where you can read. The second one, the checklist, that's your 2-page, here's what you do in this situation. I know for many people that's probably going to be the best guide. Now, all of this research comes from our behavioral science team, and we're constantly developing new tools and new studies to understand really what advisors are facing in the field and how we can better help you. And so one of the questions that you'll see in that follow-up survey is whether you'd like to participate in these types of studies and these write-ups and the tools that we develop in the future. I hope you will. You just have to check yes, and we'll follow up and tell you more about this research and share it. It's all perfectly voluntary. You're not committing to any particular project, but we want to know if you're interested, and we're happy to share this with you. Now I know we have many questions. Even going over time, I know myself, Ryan, and Sarah are happy to stay on the line and answer additional questions. But on my part, I just wanted to thank you so much for joining us today and turn it back over to James.
Thank you, Steve. We've got a number of questions, and I'll probably, Steve, you'll know from the team who'll be best placed to answer some of these, but I think the first one's probably, directed, I think you'll be the best placed. It's an interesting one. Some potential clients need help, but are very reluctant to pay fees. any ideas and techniques, please? In reading that question, one thing that sort of occurred to me was there's probably a different way of expressing it. A previous colleague of mine always used to say in financial advice, fees is only an issue in the absence of value, for being able to demonstrate that value. So when a client asks about fees, and they're actually asking, what's the intangible value? Now, I know one of the things that advisors have been hit with at the moment is a sort of action, a request to take action. I'm not paying you fees to do nothing. Have you had any sort of comments or insights on that action bias and the value equation?
I can take that one. Sure. So two parts. One on the value that advisors and planners give. Study after study, both at Morningstar as well as Merrill Lynch, Vanguard, a variety of different big shops, have found that the single most important thing that advisors and planners do is behavioral coaching. It's helping in moments like these. It's not in what people can research on the net. So they say, look, well, I can go find information about investments. The answer is yes, you're exactly right. But that's not really what advisors do. That's not how they earn their keep and really help people through. It's rather in helping them with their emotions, helping them sort through what really matters to them, their goals, instantiating that in a plan, and then keeping them on that track over time. And so I think it's putting that in context. It's not about, hey, you pay this, you get this money back, but rather we help you reach your goals. And this is all the research behind it that shows that this is what advisors do. Now, in terms of action bias, yes, that's tremendously powerful. Challenge well face. It feels very unnatural in a moment of turmoil to do nothing. And so we have a variety of techniques, actually, we talk about in the guides. One of those techniques is to absolutely take action in a narrow area. Right? So you can use a bucketing approach that says, look, we have your long-term goals. We have set aside this for our short-term movements and technical changes. Great, we're going to take that action now. You want to go heavy on Australian property? Great, okay, let's do that here. But let's not change your long-term goals. So I hope that's helpful.
I think it's a good one of the questions that's coming, which actually it's interesting you mentioned Australian property because it does link to that. And don't worry, no one's asking you for a tip of where things are going to go. It's just more the concept in Australia, and particularly between real assets that people can touch and feel versus shares. And is there any research to show that we all know that share investments over time, over long term, do provide the returns that clients need? Are there any tips or guidelines that you can give to advisors of how to deal with their clients when they like the concept of an investment that can touch and feel versus what's probably a different strategy to implement?
Ryan, I think this one might be a good one for you. Or Sarah, you want it?
Sure. I mean, I would say one thing that we're seeing right now is a tendency is a preference for physical cash more than anything, because what we're dealing with is survival fear, not just market fear. And so people want their money safe. They want to feel their cash close. And so physical things do have sort of a psychological weight to them that something as abstract as shares in a stock don't necessarily have. But again, with any of these things, these may be tendencies that we have, but individual responses to emotions are what you really have to watch for. I would say, just to that last question, sometimes what they're paying for you is absolutely to do nothing. And that may be what they're paying you for, is your ability to do nothing when that is the correct thing to do. I think that we, oh, and someone just made a comment about control. And I think in this moment, what people are feeling is a desire to have control over something, because there is so much that is uncertain, and the uncertainty is lingering for longer than what our bodies and minds are comfortable with. And it's trying it's trying everyone's psychology. And we are all learning how strong our stress and uncertainty coping mechanisms are, because our brains hate uncertainty more than almost anything else. and it's not something that we can really escape or eliminate right now. And so the longer that uncertainty lasts, the more desperate that people feel for something to hold on to, whether it's cash or something physical, or just simply the idea that they've done something.
Thanks, Sarah. One question's come in, and I'll read it. What techniques can you suggest for ensuring that a client understands the investment decision they're making and inform consent in the way that they can actually, and I know, so Steve, I think one of the things that occurred to me when I read this one is that I know you, as part of you've got a guide called Simple but Not Easy of Behavioural Techniques we at Morningstar produced a few years ago, and I know there's the letter to your future self type scenario, but perhaps some other techniques like that might be valuable to share with the advisors.
Sure. Ryan, do you want me to take this, or do you want to take it?
Oh, go for it. This is yours.
Great. So yes, the general, the letter to future self is one of those techniques, and generally we look to externalize and to slow down. Okay. Now, externalizing is the understanding that we each have and this applies for advisors as well, we each have a particular expertise and a particular view on the world, how we want to invest, how we want to proceed. And that may be well and good, but in the moment, we stray from that. We say, okay, no, things have changed. I just need to make an exception right here. And so one of the ways to help people really know what they're getting into is to write it out. To write out, often advisors do this in a simple form, in an investment policy statement, but what we advocate is a much more detailed one. Investment policy statement that covers, for example, the rules of when you want to make trades. Not when you feel afraid, but for example, for me, what I do is when it reaches a particular price to fair value, right? And the advisor and the client work together on this, and that helps them. It helps slow down the process. You know, they've already become a client, right? This is the fine tuning part. Slow down the process. They get to see it, and it has the added benefit of when the crisis hits, then the advisor can bring out this and say, hey, these are the rules we wanted to set. I saw a particular question, particularly about the letter to future self. That's a version of that externalizing, of writing out what you care about, where you explicitly write it to yourself as the investor. Right? In this case, you'd have your client do it, where they write out, okay, this is what I care about. These are the rules I want to follow. And this is why it matters to me. Future Steve, if you no longer care about your kids, if you no longer care about giving back to your society, great, deviate from this. Do whatever you want. And the advisor can pull that out and say, look, I'm not telling you what to do. This is you telling yourself. This is what mattered to you in the moment. And so that's how we pull together as someone is setting the plan, externalizing helps them know what they're getting into, right? And think about it very carefully. And then when the crisis hits, that externalizing, the writing out of the goals and the letter to the future self helps slow them down again and can bring them back to what matters.
Thank you, Steve. Thank you to all of you for your questions. We will be looking at those questions, and a Morningstar representative will most certainly be getting back to you on them. So just to close out today, a big thank you to Steve, Sarah, and Ryan. I think that is incredible, and we'll most certainly be looking to hopefully do more in the future, and hopefully the Australian advisors can see more, do more of these either via webinar or hopefully in person at some stage in the coming years. Just to conclude for the day, there's a great quote from Warren Buffett which highlights really what we try to sort of cover today. To be a successful investor, you don't need a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making those decisions and the ability to keep emotions from corroding that framework. What you've heard today is that Ryan has provided insights and understanding and education of these biases. Sarah has described the emotions of the moment, the psychology of working with your clients. And what Steve has really done is look at techniques that advisors can utilize to keep emotions from corroding the high quality strategy that you put in place for your clients. So I do hope you got a lot of value out of it, and we look forward to your feedback. With that, there will be an exit survey coming in a couple of minutes when you do exit the webinar. There will be a volatility toolkit guide, which Steve did mention in the presentation, that will be emailed through to you. And of equal importance in the current times of you as professionals, CPD points that will also be coming through to you in the coming week. So thank you once again. We do appreciate your time, and have a wonderful day. And thanks again to our colleagues in the US. Thank you.